My name is Jake, welcome to the channel. In today's video, we're gonna do another Review My Pie video where I review subscriber portfolios. But before we do that, holy cow, can we just talk about this for a second? What is going on with the market? I guess you could kind of say it was to be expected, with everything that is going on in 2020, with, what's coming up here this next week with a lot of uncertainty, right? I look at my own portfolio, I'm down over $5,000 in the last 5 days. And I think about this as, well, you know what? I dollar cost average into my portfolio. I have a long-term horizon. And so for me, when I see this pullback in the market and when I see that my portfolio is all in the red, it really gets me excited because that means I get to increase my yield on cost. The average price that I'm paying for these holdings and the yield that I'm receiving from my investments. And I dollar cost average into my portfolio. I hold a little bit on the side just in case, right? For an emergency or if there is a big, shock to the market where the market pulls back 5, 6, 7, 10% in some cases, I do buy more. And so this week I bought a little bit more into my portfolio. I have reoccurring transfers set into my M1 cash flow portfolio of about $1,000 a week. And this week I added in an additional $2,000 into the portfolio that I normally do. So I am definitely taking advantage of this pullback. And I hope if you're a new investor, you see this volatility, you understand it. Don't let it discourage you from investing into the stock market. Really understand that this is a normal process, normal cycle in the stock market. I think it's just important that you understand that volatility is always going to be there. It's just part of the process. And if you understand it, you can really take advantage of it and come out on top. So in today's Review My Pie, we're going to take a look at 4 different portfolios. The first one is going to be from an individual that is down here in Texas, where I'm actually currently at. I live in Austin, Texas. So really cool to see some Texans following the channel, of a 37-year-old. The second portfolio is going to be from a 47-year-old based out of Europe. The third portfolio is going to be of a 31-year-old here in the United States. And then the fourth portfolio of a 22-year-old out of Boston. As always, everybody, I don't review the portfolios before reviewing them. So when I view them, I'm looking at them for the very first time. I don't pre-script anything that I'm going to say. Everything done here is pretty much as live as it can be. As always, I am not a financial advisor, so don't take what I'm saying as professional financial advice. This video is just merely for your entertainment. All right, the first portfolio here is from Claudius. Claudius writes, "Hi Jake, thank you for the info that you give on your YouTube channel regarding investing. I like your YouTube videos and I am a follower. Thank you for what you do and the info you share." Thank you so much. I really, really appreciate the kind words. I'm 37 years old, living in Texas, and I have 2 portfolios on M1 Finance. Would appreciate it if you could have a look at these 2 portfolios. Would appreciate your advice and would like to know what changes I should make and if I'm on the right track. I currently add about $400 per month to these 2 portfolios in M1 Finance. I'm planning to invest for the long term for 25 to 30 years. Okay, so you got, it looks like they're both Roth portfolios. Okay, so you have 2 Roths. I'm currently working at a company and they do match 5% of their retirement plans. I put 7% in, have a Roth 401k retirement account, and I'm investing 8% and the company matches me with 5%. I'm increasing my amount each year with 1% that I do contribute to the retirement account. My funds that I invest in my Roth 401k are the following. Okay, so you got some 20%, 30%. Okay, good. Got some Vanguard in there. Okay, these are good. Do you think these are good mutual funds to be in? The expense ratios are not too bad, and those mutual funds, with the exception of the one there. So, well, first off, thanks again for sending over your portfolio. Well, let's just take a look at your 401k here first. So, when it comes to your 401k, I really, really like matching, investing at least up until the employer match. I mean, that's free money. I mean, if you have an employer match, I think in most cases, almost 99% of people would be better off first at least investing to their employer's match. I actually shared an entire video on the order of investments here in a previous video on how I invest for FIRE, financial independence and retire early, and leveraging these different tax advantaged or sheltered accounts and the order in which I invest in them. When it comes to mutual funds or index funds, for everybody watching the video, my channel is really tailored towards new investors. So a mutual fund is a little bit different than an index fund. An index fund follows an index, and therefore the owner of the index, or the fund, I guess you could say, is much more passive. There's less expenses involved, and therefore it costs significantly less than an actively managed mutual fund. So that's the big difference. Mutual fund is actively managed. Index fund, it is passively managed. Mutual funds typically cost more. And in most cases, you're better off going with an index fund because most fund managers that are, or funds that are actively managed can't beat the index anyways. And that's just historically been the case. I prefer to keep it simple. In my Roth 401k, I hold two funds. I hold the S&P 500 and the Vanguard real estate ETF. Like that's all I have in my Roth 401k. And that really, it works for me. I found that simplicity is the best way. And because I changed jobs a little bit more in my industry where I work in the technology sector, I found that it's easier for me if I keep it simple. And so when it comes to the funds that you have, the most important thing to take a look at is the expense ratio. That is the most important thing. And also understanding different asset classes. What I mean by that is equities versus bonds. And depending on your time horizon, you're really going to want to understand that piece of it. I invest 100% into equities. I don't hold any bonds. And that may be the case for a lot of you. Maybe some of you feel that you want to invest into bonds, and that's completely fine. But I think it's important to understand those things. Expenses, I always prefer to go lower expenses, so I skew more towards index funds, and keep it simple. Let's take a look at your first Roth IRA portfolio here in M1 Finance. So over the last 5 years, you're up 41%. That's not considering the reinvestment of dividends. You can see here these last couple of weeks, market has seen quite a big shock. But if you're invested for the long term and you're invested for dividend growth, I mean, it's a great opportunity to buy in and increase your yield on cost. I mean, it's absolutely a great time. 35 holdings, a little bit of an expense ratio. This is absolutely fine. This is not a crazy high expense ratio. I personally like having it under, 0.2, or 2.5. Like I really like to keep it below that personally. And let's see what you got here. So you got high dividend ETFs at 35, growth ETF portfolio at 30, dividend growth portfolio at 20, real estate portfolio at 15. Okay, great. So real estate, I like that you have it at 15. You don't have it at a crazy high amount. And the others is not based off of sectors. So let's take a look and see what you have in your first slice. Your first slice, you got a fund, high dividend fund from Wisdom Tree. Okay. Good. VYM, love VYM, SCHD, love SCHD, and SPYD. That's also a really good one. Okay, the reason why I don't invest into SPYD right now is because it has more exposure in real estate, and so the taxes are a little bit different. But in a Roth IRA, SPYD would be a really good fit. So really interesting. I like all of these funds. All of these funds are really strong. VYM is really good. SCHD is really good. And as I mentioned, I don't invest into SPYD today, but I'm really considering it once again because the exposure with the taxes. That's the only reason why. I think all four of these dividend ETFs are great. Now, obviously, these are underperforming the broader market. If you look at the S&P 500, which is made up of 25% of the 5 largest, FANG companies out there with like Google and Amazon and Apple and Microsoft, etc., like this slice is greatly underperforming when comparing it to those other investments. But from a dividend perspective, when you're looking at this from a cash flow perspective, this is a high quality slice. All of these ETFs, you can sleep well at night and dollar cost average into these investments. When you see your portfolio dip like this, you should be getting greedy. You should be getting greedy when you see your portfolio drop like this. You should be investing more and lowering your average cost per share and thereby increase your yield on cost. Let's see what you have in your growth ETF portfolio. So you see you got 92% up here. Decent dividend yield, actually. Still 1.7, give or take. Low expense ratio, VGT, VUG, QQQ. These are really good. As I mentioned, similar to your dividend ETFs, these are really high quality ETFs. They're low fee. This is probably my favorite growth ETF. This is me personally. I really, really like VGT. I have it in my Roth IRA, right? Like this is when I invest for my kid, when my wife and I have kids and we're looking to say, start maybe a custodial account or whatever it may be, VGT is going to be the largest holding in that portfolio. So really, really high quality ETFs. QQQ is also really, really great. The Vanguard Growth one is great. The one from the Spider is also really good. SPYG. Like these are really high quality ETFs. What do you got here in your dividend growth portfolio at 20%? So up 38, 2.5%, pretty okay, decent expense ratio, mostly Wisdom Tree ETFs. DGRO, great. This is what I have in my portfolio as well. DGRW, I really like DGRW. This is a really, really good one, especially if you have 20 years or more for this to compound. DGRW is a great, great dividend growth ETF. The difference between DGRW and DGRO, or quite frankly for most ETFs, is DGRW looks at the potential of future growth, where the majority of other ETFs that follow an index or a dividend growth or a different dividend appreciation index, they're looking at historical returns. With DGRW, they do it with a twist. They have a forward-looking approach. That's why you're going to see a higher expense ratio of, pretty significantly higher compared to DGRO of, as you can see here, because the way that the fund managers of these ETFs, the way that it tracks the holdings in there, or the way that they value them and assess them, is done very differently. So really, really cool. These are all really, really great. Let's take a look at your last slice here, your real estate portfolio slice. You got, and these are not ETFs. The rest were ETFs, right? Yeah, the rest were ETFs. Let's take a look. These are individual. So this is all real estate. What do you got in here? You got Welltower, you got WPC, VTR, Store, Stag, Realty Income, PSA, Public Storage, Prologis. So everything up to here, I have in my portfolio as well. I don't have Healthcare Trust of America. I got Equinix, I got DLR, I got Cone, I got Crown Castle, AMT. I don't have Doc. The majority of these I have in my own portfolio as well. So these are really, really high quality REITs. One thing that you could also take a look at if you wanted to round out your portfolio, it looks like a lot of your others are in ETF, like your holdings are in ETFs. VNQ is a great real estate REIT. SCHH is another really good one. USRT is another really good one that I really like. But the majority of these here are really good. I like that you got Prologis, you got Public Storage. A lot of these, DLR, these are really, really good. So what I'm looking for here, for those of you that are maybe new to the channel, what I'm looking for are more so your riskier REITs, right? Your mortgage REITs. Mortgage REITs are a little bit different, and you don't have any mortgage REITs in here, and I really like the fact that you don't have that in here. One thing that I'm considering in my own portfolio is with healthcare. Healthcare REITs are getting destroyed right now. Healthcare is just, with the pandemic in 2020, it's just been so challenging for these healthcare REITs to stay afloat, whereas compared to like a cell tower or, for example, a Stag Industrials, right? It's a whole different landscape. But I think the way that you have it set up here, it's very well diversified. Like a lot of people don't understand with real estate, with REITs, they're kind of have they have their own sectors themselves, right? It's like, in traditional sectors with consumer staples, industrials, healthcare, all that stuff, you have all of that as well in real estate investment trusts. So really, really good. You have a good high dividend. You have a few monthly payers in here. The ones that you do have, right, with Stag, with Realty Income, with LTC, these are good monthly dividend REITs. So really, really good. What's the performance been? 55. Great. Well, thank you so much for sending over your portfolio. I think your portfolio is really good. It's manageable. You have 35 holdings in here. There's no holdings in here where I would say, hey, you really got to take a look at this. This is a major red flag. I think you put a lot of thought and effort into this portfolio. Let's take a look and see what you have in your second portfolio here. It's up 94%. You have 71 holdings, 2.3%. You have it broken up in technology, healthcare, consumer discretionary, consumer staples. Okay, so this is more so based off of sectors. The allocation is good. You got 18% in technology. It is a Roth IRA. Really good. Materials and real estate down here. You don't have any energy. So technology, you got your main names here. You got Qualcomm, your Texas Instruments. Yeah, these are all really, really good. All US based, I can see as well. MasterCard and Visa. If you've been following the stock market, they just got crushed this last week. If you wanted to get into Visa or MasterCard, right now is a really, really good time. Typically, MasterCard and Visa are so overpriced. It's so difficult to get into a good valuation with Visa. Like, look at this. Right now, if you wanted to buy into Visa right now is a great time to buy into Visa. It has a lower starting yield, right? But it is a great growth company. If you wanted to get into Visa, now is a really, really good time, in my opinion. All right, let's take a look and see what you got in your healthcare. Healthcare, you got Merck, Johnson & Johnson, AbbVie. These are really good. They're equally weighted. I'm completely fine with that. That looks great. Consumer discretionary, we're kind of blowing through this one a little bit quicker so I can get through everything. You got Lowe's, McDonald's, Home Depot, Amazon. So you got a few growth trickled in there as well with Tesla and Alibaba, which is fine. I personally like to separate growth, like pure growth plays from my dividend plays. It just helps me to kind of, it just, for me personally, I view them separately. Pure growth plays versus cash flow. I just look at them differently. Consumer staples, you got Walmart, you got Kroger. These are all really, really good. You got Pepsi in there as well. They're all equally weighted. These are great. There's a big difference between Costco and Coca-Cola. Costco is really, really in growth mode right now, where Coca-Cola is more in value. It's not growing nearly as fast as it used to. But Pepsi, on the other hand, is a good balance between the two. Let's see, you got utilities, you got Dominion, Southern Company, NextEra Energy, Duke, American Water Works. All very, very good. NextEra Energy, if you're in M1 Finance, NextEra Energy just went through a stock split. So kind of interesting. You can see how they do that in M1 Finance. It shows if you do have NextEra Energy, you can take a look into your activity feed in M1 and it'll show the stock split. Communication services, what do you got in here? You got Disney, Verizon, Facebook, AT&T, and Google. All really, really great companies. Once again, trickled in there with growth and current yield for income. Industrials, what do you got in here? You got 3M, you got Waste Management. Love seeing Waste Management in there. You got UPS, Union Pacific, Honeywell, Caterpillar. All of these are really, really great. You got a few really, these are really great companies. Most of them are dividend aristocrat, and if not all of them, you even have a few kings in here. So really, really great industrial companies in there. Real estate, what do you got in here? You got the majority of the ones that you had in your previous slice that we just took a look at. Really, really good. Materials, what do you got in here? You got Sherwin-Williams, PPG, Ecolab. These are all really, really great. One that I've been really interested in lately is International Paper. International Paper has been doing really, really well here in 2020, and they have a high starting yield. So one that I've been taking a look at. But these are also really, really good. Well, cool. So this is your second portfolio. Thank you so much for sending over your portfolios. These are really, really great. As I mentioned, you have really high quality companies in here. The one thing that I would say, so we talked about your Roth 401k. When it comes to your Roth IRA, I personally, in my Roth IRA, I have, I think, 5 different ETFs. I don't have any individual companies in my Roth IRA. The reason why is I set up my Roth IRA and I'm not even going to look at it for the next, how old am I? I'm in mid-30s, 30. Shit, I kind of forgot how old I was. I'm going to let it sit there for almost 20, 25 years and never touch it. And so for me, I just want to keep it simple. In my Roth IRA, I just have a handful of ETFs. I set it up and I never look at it. Like I don't even look at it at all. That's why I have my Roth through Vanguard. If I didn't have it through Vanguard, I would have it through M1. But I just set it up and I forget about it. Everything that I talk about on M1 Finance here on the channel, it's all in my taxable account because I'm looking to leverage the dividends earlier than the traditional age of 59 and a half to live off of the cash flow. So a few, food for thought there. Understand, you still have some time for the portfolio to grow. The more you play with the portfolio, typically the more diminishing returns you're going to have. So try to set it up in a way that you can set it and forget it. That's really truly my opinion. I think most people in that situation would benefit from that. And if you want to play around with it, I would recommend playing around more in a taxable account. That's just my opinion, personal preference, but great job. Thank you again for sending over your portfolio. All right, let's take a look at the second portfolio here. The second portfolio is from Yorgos. I hope I'm pronouncing that correctly. I have to admit, I did do a Google search on how to pronounce it. I believe it's a Greek name. I hope that I pronounced it correctly. You write here, hello Jake, and thanks for your reply to my YouTube comment. I'm a fairly new investor, 47 years old, and wish to secure my family for retirement in about 13 to 15 years. I intend to invest about 30,000 euros to start and then add all of my leftover income on a monthly basis towards my investments in order to live with my dividends. About 60 to 70,000 euros would be sufficient. That is great. Well, let's take a look at it. So you're using Trading 212. For everybody out there, non-US, I believe it's available in Canada, if I'm not mistaken, but I know across Europe, Trading 212, I've heard a mixed feedback on them. Some say they love it, some say they hate it. The auto rebalancing, etc. You can also build pies with it. Kind of cool. But let's take a look at it and see what you have. All right, so when it comes to the user interface of Trading 212, it's fairly similar in terms of like the pies that you can build out, but let's take a look and see what you have in your portfolio. So your highest holding is Johnson & Johnson. And once again, I'm trying to remember, you said that you're looking to live off of your portfolio here in 13 to 15 years. So 13 to 15 years is not a long time in terms of the, the miracle of compounding, right? If you have less than 20 years, or let's say around 15 years, you want to balance between growth and current income simply because of your time horizon, right? And so what I like to look at, if your time horizon is between 10 and 15 years, I like looking at a 3% starting yield as the portfolio yield. So around a 3% current yield is what you're going to want for your overall portfolio. And I don't think that Trading 212 is going to show your actual current yield. Okay, but just as an FYI, that's kind of the sweet spot that I personally look for between 10, around that 15 year range. So Johnson & Johnson right now is yielding just under 3% because of the pullback. Right now is a really, really good time to get into Johnson & Johnson, just FYI. Johnson & Johnson is kind of like with Visa. It doesn't drop a lot, and when it does, you really have to take advantage of it because it doesn't stay low for long. Johnson & Johnson is really good. Pepsi at 7%, Texas Instruments at 7%. Barrick Gold at 7%. They've been in the news. I think they just increased their dividend quite significantly here lately. Coca-Cola, really, really good. AT&T, good. Pfizer, Altria Group, Home Depot, Unilever, really good. Procter & Gamble, Enbridge, Bank of America, ABB, AbbVie, Chevron. I like that you have Chevron down here a little bit lower. Chevron is a good one. Clorox is really good. McDonald's and Wells Fargo. These are all really, really good. Fortune 500 companies. These are really, really good companies. So when it comes to your goals, I think you're going to be able to achieve that with this portfolio. It's not a super hyper growth portfolio. You do have growth in, Pepsi is growing. Texas Instruments, yeah, it is. You're looking at others like McDonald's. McDonald's is growing very, very quickly. Like your fastest growing company here would be maybe AbbVie and McDonald's. AbbVie just increased their dividend by around 10%, if I'm not mistaken. Really, really high growth dividend grower. But I mean, there's a lot of established companies, right? You got Altria Group in here. You got Pfizer, AT&T yielding over 7%, Altria Group yielding like over almost 9%, if I'm not mistaken. Just incredibly high dividend yields. So I like that you have a balance between really high quality and maybe there's a few little speculation in there. There's a little bit with Chevron. Nobody really knows what's going to happen in 15 years with Chevron. I still believe that they're going to be around. What's going to happen with, who knows, right? And also with Altria Group, right? They're focused on the U.S. with government intervention, regulation. There's maybe some what ifs, but overall, I think the portfolio is really well constructed. You have the allocation set up well. I don't like to have more than 5% in a single holding. So if this is the only portfolio you have, that's kind of my rule of thumb in an individual stock. I try to have right around 5%. However, the companies that you do have, like Johnson & Johnson, Pepsi, like these companies aren't going anywhere. So I think they're really, really good. Thank you so much for sending over your portfolio. It's really cool seeing how Trading 212 is set up. So for all the European viewers out there, this is maybe a good alternative. Once again, I've never used it. I can't really say from personal experience, but it kind of appears on the surface as a potentially good platform or alternative to M1 Finance. All right, the third portfolio here is from Michael. Michael writes, I like to begin by saying I really enjoy your M1 Pi review content, and because of you, I decided to open an M1 Finance account. Well, hey, Michael, thank you so much. I really, really appreciate you saying, your kind words. After watching the first episode of Review My Pi, I ended up watching the entire series in one sitting and still wanted more. That's why I'm here in your inbox. I would love some critique on my portfolio. I'm new to the FIRE community, FIRE for everybody, financial independence, retire early, and your video content has inspired me even more. Thank you and continue the great work. Michael, thank you so much, man. I really, really appreciate it. It really means a lot to me. All right, FIRE. So you write here, I'm 31 years old. My goal is to build a dividend growth portfolio that is diversified with the potential to live off of in about 15 to 20 years. And from now to supplement my income. I'm fairly new to M1 Finance, and I have to say that dynamic rebalancing and Pi feature is just perfect. Now, if Fidelity could do that. No, I hear you. I hear you. Like with brokerages, it's insane how much a brokerage can impact your investing habits and all of that stuff. It's crazy. So you continue writing here, 3 accounts and contribution amount. I currently have 3 accounts with Fidelity, and I've owned these accounts for roughly 2 years and some months. The first one is the HSA account. I max this out every year. This is great. Highly recommend. If you have an HSA, highly recommend maxing it out. Mixture of growth, tech mutual fund, and REITs, really good. I like index funds a little bit better, but if they don't offer it, that's likely fine as well. Roth IRA, I've maxed out every year so far. Growth, tech mutual funds, REITs, 70-30. 401k Roth, close to maxing out every year about, wow, man, so you're maxing out all of these accounts. You must have a really good paying job or keep your expenses really, really low. This is great. Okay, so I choose the allocation for my HSA and Roth IRA because the balance each year well over minimized volatility, especially drawdown. Okay. Because of the new addition to the family, M1, I will have to readjust my contribution to my 401k. All right. Prior to this email, I had 2 investment goal strategies with M1 Finance. First, I wanted to pick the top 10 high quality growth stocks from different sectors and contribute $10,000 at a minimum to these stocks for the next 15 to 20 years. I'm fairly young and I'm not afraid to take some risk. Yeah, you heard the stock market. Yeah, I know. Stock market is kind of a crazy time. Secondly, I wanted to create a portfolio within M1 that was well diversified with quality growth stocks that I can contribute $10,000 at the minimum for the next 15 to 20 years. I do not plan to invest into international stocks or ETFs. In reference to bonds, maybe 1% someday. Okay, yeah, that sounds fine. So growth stocks, no international, individual, you want to focus on really your top 10 high quality core stocks. Great. Feedback. So what do you got down here? Feedback. So what's your opinion concerning these 2 strategies in reference to achieving FIRE in the next 15 to 20 years? What are the advantages and disadvantages of concerning both strategies? Do you think my current Pi distribution makes sense for my goal? If not, what changes would you recommend? If I am too heavily exposed to any sectors, what would you recommend? The top 10 stocks I've had in mind. I've done my research. Okay. Closing note, just to clarify, you'll notice that I have T in my own for life and dividend growth slice. I propose transferring T to a different, okay. All right, when it comes to your two strategies that you're looking to achieve here, I think it's important to understand, okay, if your goal is to achieve FIRE in the next 15 to 20 years, understand that achieving FIRE is different for every person, right? Financial independence from retire early. My wife and I, we are striving for a little bit of a different approach to FIRE. The traditional approach is you invest into one, VTSAX, the total stock market, US stock market, and then you amass, 20 to 25 times your annual expenses, and then you never have to work again. We're doing it a little bit differently, where we're looking to live 100% off the cash flow from our portfolio. So our investments are a little bit different. I think that this could work, right? When you're saying, hey, I want to just focus on 10 high quality stocks for the next 10 to 20 years, right? And then either live off of the dividend income from these stocks, or maybe even sell them. You have the different options, right? I think it could work. If you're only going to bank on individual stocks for FIRE, be aware that, high risk, high reward. There's the potential that one of these companies, that they're no longer there, right? And that's why we diversify. That's why we have 10 instead of 3 or 4. So understand that when achieving FIRE, the most important thing for my wife and I is we don't want to go to bed at night worrying that one day maybe one of our investments is going to go bankrupt, or we're going to, have to one day potentially go back to work. We want to have enough insulation that we can go to bed at night once we reach FIRE, that we're done. We don't have to worry again. And that's what I would have, encourage you to think about. Okay, is this strategy going to allow you in 20 years to kind of flip off the switch if you wanted to, right? Not everybody seeking FIRE is also looking to retire early, right? But if that's what you're trying to do and flip off that switch and never work again, you really want to make sure that what you're doing is you're going to be able in 20 years to go to bed at night and not have to have that hover over you. Oh, if something happens to one or two of my investments, am I going to have to go back to work? That's the big advice that I would give you there, is really understand, because every person is different. Everyone has a different risk tolerance, but I think your strategy can work very well. I'm very impressed that you're investing in your HSA, you're investing in your Roth IRA and your Roth 401k. To say it point blank, you got your shit together, right? I think whatever you do, try to keep it as simple as possible. Don't try to over engineer it. Keep it as simple as possible. And that would be the best advice that I could give anyone. But it sounds like you're a little bit different. You think differently. You really want to get into the nitty gritty. And I think the FIRE movement is absolutely perfect for you. So Michael, you sent me over another email with 2 links to 2 different portfolios. Let's take a look at them. I think one was focused on your original goals, right, with achieving FIRE with the dividend growth approach, and the other one was the growth approach. So let's take a look at your original pie that you sent here. You're up 125%. That's incredible. You have 36 holdings. You have a 3.77 dividend yield. I mean, this is incredible. This is really, really great numbers. Like really low amount of holdings, really great dividend yield, really great return, really high quality portfolio. So I'm curious of what you got in here. In your first slice, let's see here, you got Own for Life. You got Broadcom, Apple, Microsoft, AT&T, VTI, that's the VTSAX, and you got BND, the total bond market. This is really, really good. I think you have a little bit, you're more central, you're more focused on Broadcom and Apple and Microsoft, but I think that's okay. These are really, really high quality companies. These companies are going to be around. I think it's fine. I try to limit the amount of exposure to any one given stock. I try to keep all of my individual holdings less than 5% of my total overall portfolio. But given that these, Apple and Microsoft, they're not going anywhere. So these are really, really good. Dividend growth, what do you got in here? You got OKE, you got DLR, and you got AT&T. So I think you said that you were also going to be moving AT&T over as well. So this is your dividend growth. This is more so your, you got a mixture of dividend growth and current income. With DLR is growing much quicker than AT&T, but with AT&T just right around an 8% dividend yield, whereas DLR right around a 3%. So a good balance to the overall portfolio, balancing high yield with lower yield, but growing faster. Let's see what you got in your real estate. You got Realty Income, American Tower, Prologis, and Arbor Realty. Really, really good. I mean, these are all really good REITs. What do you got in your growth? You got Facebook, Adobe, and Tesla. Also really, really good. Yeah, I don't think you can go really wrong with that. I like Amazon as well, and Google. Amazon and Google are also really good. If you're going to focus on growth, I mean, it's just unbelievable, right? Just incredible the amount of growth since just this year, right? Like, look at this. This was just this year. It's incredible. Utilities, you got Nextra Energy, you got Southern Company, you got Duke. These are all really good. I like Duke. I own all three of these. These are great. What do you got in here for healthcare? You got Johnson & Johnson, AbbVie, and United Healthcare. These are also really, really good. AbbVie just increased their dividend by 10% this last week. Really good. Consumers, Pepsi, Procter & Gamble, Coke, Kimberly-Clark, and Altria Group. Yeah, these are good. These are really good. With your time horizon, I think that's fine. I think it's fine. These are really sleep well at night. What I'm thinking about is, with your time horizon, with the current yield versus the growth rate, Pepsi is really good. You're averaging right around a 3%. You could even bump up Altria Group a little bit to get like a 3.5%. That's what I personally have done with my portfolio. Like, for example, this is just personal preference. What you could do is you could lower Pepsi a little bit and Procter & Gamble a little bit and increase Coke, Kimberly-Clark, and Altria Group. Another big advantage of having Altria Group, Kimberly-Clark in here as well, like all three of these, they're on different pay schedules, right? So Pepsi is paying a dividend at different times of the year than Coca-Cola, Kimberly-Clark, and Altria Group. So you're spreading out your dividends. So that's also a really big advantage of having these individual holdings as well. These are really good, by the way. What do you got in here? You got industrials, makes up a smaller portion. You got Union Pacific, 3M, Waste Management, yes, love it, and UPS, great companies. I love seeing Waste Management in there. Financials, you got JP Morgan, Bank of America, and MasterCard. Great. Like I mentioned in a previous review, MasterCard is really, really on sale right now. They took a huge dive this last week or so. So good buying opportunity to get into them. And discretionary, what do you got in discretionary? McDonald's, Disney, and Home Depot. Great. All really, really great companies. So this is a great portfolio. You have a really high starting yield. You have real estate trickled in there as well, so you're getting a higher current yield. You have a manageable amount of holdings. You have growth in here. I think this is great. So with FIRE, right, you have Adobe in there, you have Tesla in there, so you're going to be able to sell the holdings and maybe at the time of early retirement either buy other assets that cash flow or cash them in and pay for maybe a down payment on a house or a vacation or whatever it may be. So really, it can work very, very well. Let's take a look at your growth portfolio here. You're up 500%, 3.5 dividend yield, 12 holdings, own for life. What do you got in here? So similar to the other one, you got Broadcom, you got Apple, Microsoft, Verizon, VTI, and BND. Really good. Growth, what do you got in here? You got Square, Qualcomm, and Etsy. These are really, really good. I really like Square. I really like Qualcomm, and I really like Etsy. Like anything that you can, that will help you buy online, sell online, all of that stuff. This is so great. And you can see, right, like this has just been dominating. I really like Square. I really like Etsy. I think these are really great growth companies, like just amazing. They've gone up really, really high. I think they're going to continue to go down here these next couple of weeks, but I think over the long term, I think they're going to do really, really, really well. So what do you got here in your dividend growth? Dividend growth, you got, it's the same as the other slice in here. You got AT&T, DLR, and OKE. I think this can work. I personally like AT&T. I have it in my portfolio. DLR I have in my portfolio. I don't personally own OKE. I'm not I don't really own any individual energy companies or natural gas. Like I don't own any of them personally in my portfolio. I think it's, high risk, high reward. Nobody really knows what's going to happen 5, 10 years from now with the energy sector. A lot of it has to do with the political landscape. Like there's just a lot of uncertainty. It could actually end up working really well for you. But coming back to what I was talking a little bit earlier about with FIRE, when I reach FIRE, the investments that I hold in my portfolio, I want to go to bed at night knowing with a pretty good degree of certainty that I'm not going to have any surprises. Like that's what I've really, really focused in my portfolio. That's why I have half of it allocated to ETFs and I've had the other holdings spread out. I really try to diversify my portfolio. And with this is, here you have 33%. You have a lot of exposure to one individual holding. So if I have any critique for you is I would reassess and understand, okay, is this the approach that you want, right? And the best advice that I can give you is fast forward 20 years. You resign from your job, you no longer are working, you and your wife, etc., and you say, okay, we're done working. Do you feel comfortable having so much exposure into one individual holding and being able to sleep at night knowing that, there's a possibility that something outside of your control could happen and that it could force you to run into pretty tough times in some cases, right? And so if you, based off of the answer to that question, that'll help guide you in setting up your portfolio and the percentages in the portfolio that you have. That's what I've done for me personally, right? This has helped me a lot when setting up my portfolio. I try to think into the future. In 20 years, what is my ideal situation? What do I ideally want to have? And do I want to have more exposure into this sector and this individual company? And I've decided for me, I want to set my portfolio up for growth. I want to take advantage of growth, but I also I want to be a little bit more conservative, like a conservative growth, I guess you could say. The main goal for me is I want to be free. I want to be financially free, and I don't want to be stressed out by my portfolio. And that's why I always recommend keeping it as simple as possible. Thank you again, Michael, so much for sending over your portfolio. It was really exciting seeing the different types of holdings that you have in here. I mean, this is absolutely a growth portfolio. It's just remarkable. All right, let's take a look at the last one here. The last one is from Revless. Revless writes, before I get into my portfolio, I'd like to thank you for your YouTube content. I've learned a lot and started my portfolio after watching your videos. This series really taught me that dividend investing can be fun and pay off in the long run. Ex-wannabe day trader here. I even talked to my fiance and got her excited to invest with me after showing her some of your videos. Thank you so much, man. I really, really appreciate you saying that, right? When you create a YouTube video here on YouTube, right, you read the comments. Some comments are good, some comments are constructive, some comments are just kind of trolly. But like when I see comments like this, it's like, holy cow, man, like I'm actually helping other people. And that's been my goal since the beginning, right? When I first talked with my wife about investing, she'd never heard about it. And, we don't learn about investing in school. And, growing up, I always thought that I would be successful, but I had no idea what it meant to be successful in terms of, managing my finances and all of that stuff. So thank you so much for the kind words. So some background info. I'm currently 22 years old and just graduated from college, MIS major. I'm planning to stay for one more year to finish my master's, hopefully by summer 2021, while working at a part-time job. I plan to invest more into my portfolio once I graduate and find a job. My parents have helped me a lot with my expenses and with college, so I'm lucky to say that I have low expenses and no debt. I'm from Massachusetts. That is amazing. So when you're 22 years old, when you're going to college, the big thing there is you're not going to make a ton of money right during college, right? The key thing there is to keep your expenses low. And the key thing, I can't tell you enough, the most important thing is once you graduate, don't go buy a brand new BMW. Don't go buy a brand new car. The best thing that you can do right out of college, if you have student loan debt, pay it off. Don't go into debt. That is the number one thing. When I look back on my experience, don't buy that brand new car. Don't do it. If you're really serious about investing, if I would have known that buying that brand new car right out of college, that I could have retired 2 years earlier, like I kind of beat myself up thinking about it. So really, you're in a great time right now. You're in your early 20s. All right, so you're writing here your portfolio status. I started on July 1st, 2020 with a small lump sum of $500 and have been adding $50 a week using the dollar cost averaging approach. Great. I plan to continue adding $50 a week for the foreseeable future. Once I graduate and join the workforce, I plan to earn around $200 to $300 a week depending on my financial situation. I keep my dividends in the account and reinvest them when I can. My account is in a taxable account. My portfolio is divided into 10 sectors. For the most part, I'd say about 90% of my portfolio consists of fairly safe dividend stocks. I do have 3 to 4 risky stocks. For the most part, I don't plan to sell anything unless something big changes in the company's fundamentals. Really good. I've got about 42 holdings currently with about a 3% dividend yield. My goal is to generate enough dividends to be able to live off of in my early to mid 50s, about 30 to 35 years. My long-term goal is to be able to get about 40,000 in dividends a year to be able to retire. I also want to create generational wealth so that my future kids won't have a hard life. And that is such a great goal. That is so amazing. 30 to 35 years. Okay, so my questions. I'm wondering, what are your thoughts on the risky stocks that I have? Although some have performed in terms of growth, I'm still debating whether to keep them or sell them or move on to safer places. Although my yield is about 3%, do you think by the time I'm older, the yield will grow? Great question. I feel like I'm missing out on not having WMT or Costco. Would you recommend adding either one? Any changes or recommendations? Well, this is a really great email. I'm so glad that you took the time to send this. There's a lot of stuff to kind of take a look at. The very first thing that I would tell you is the same thing that I say over and over again on my channel is focus on 3 things. When you're first starting out, you're about to graduate, focus on cutting your expenses. Cut your expenses, right? Whether it be, you're paying $300 a month for food, see if you can get that down a little bit, right? If you're spending money that you shouldn't be, try to get that down. If you have an expensive phone bill, right? Say you have AT&T or Verizon, you're paying $100 a month on your phone bill. There's other phone plans out there you can get for $10 a month, right? Those kind of things can move the needle and can have a big impact over the long term. The second thing is cut consumer debt. If you have student loans, pay them off as quick as you can. Don't go and buy a brand new car once you graduate. Those kind of things, keep your consumer debt low or eliminate it entirely. And then the third thing is look to earn more money, right? You're just going to be entering the workforce. The best thing, what I wish I would have done when I was in my early 20s, if I was able, is house hack. Really house hack. Buy maybe a duplex, move into the one side, and then rent out the other side. Really, that's the big thing that most people, at least here in the United States, that most people can do. It's a little bit of work. Maybe it takes, you have to learn how to change a faucet, or you learn how to change, the carpets, or whatever it may be. Learning how to house hack is a really great way when you're in your early 20s to do that. And now you said that you have a fiance, so you're probably not going to have roommates, but maybe a duplex would be a really good idea for you. Just something to think about. So on to your questions. The risky stocks, as long as they don't make up maybe 5% of your overall portfolio, I say go to town. Go for it. As long as they don't make up a big portion of your portfolio, as long as your core is 90, 95%, go have fun with it. You can spend 5, 10% of your overall portfolio, maybe in Bitcoin, maybe in gold, maybe in whatever it may be. It's completely fine. But I think 90% should be in your core holdings. All right, your second question here, although when looking at the yield, the 3%, companies are not going to always pay that yield. That's why we talk about dividend growth, right? The companies are growing their dividend. Like, for example, with AbbVie just increased their dividend by 10%, right? The yield, depending on when you buy the stock, you're going to get that current yield. The longer you hold on to it, and if a company is growing its dividend, for example, like AbbVie is growing at 10%, you just got a 10% pay increase, right? I don't know a lot of people that get a 10% pay raise at their job every year, right? AbbVie just increased everybody's dividend payout by 10% that was a shareholder of AbbVie. Really cool example. So the dividend is growing. So what I would recommend you do there is understand what is yield on cost. That's the key thing there. The third question here with Walmart and Costco, I think they're both really great. I personally own both. Costco has a much smaller smaller current yield compared to Walmart, but Costco is also growing it significantly faster. I think they're both great stocks. So let's take a look at your portfolio and see what you got in here. So over the last 5 years, you're up over 55%. You have a really low expense ratio, so you got a few ETFs in here maybe. You got a good dividend yield of just over 3%, and you have 42 holdings, right? Okay, so you look at your portfolio, you're up 55%. We looked at other portfolios that were up over 100%, 500%, right? Dividend growth, you can get growth. You can invest in a Microsoft. It has a 1% dividend yield, right? Apple. But like, depending on your goals, right? If you want to live off of the dividend cash flow of the portfolio, you're not going to have that 500, 700% capital appreciation. You're just not going to have it and get the current yield. Okay, your portfolio is yielding a very similar percentage as my portfolio, right? And so you can see this kind of this drop right here. So let's see what you got here in your portfolio. You got 15% allocated to tech, 15% into ETFs, 12% in real estate, 12% in industrials, 11% in financials, 10% in healthcare, 10% in consumers, 7% in utilities, 6% in telecom, and 2% in energy. Now I have to understand, right? So your goal is 30 to 35 years. You have a long time. So you want to have tech in the highest, like if you truly are going to sit on their portfolio for 30 years, you can even bump up technology to 20%. If 30 years is your time horizon, I would even encourage you to bump up tech, maybe even a little bit more. When it comes to utilities, if you do have 30 years, you could bump down utilities, okay? That's just how it is. And so what that will do is it will lower your dividend yield, right? This dividend yield, but that's okay because you have 30 years for this to compound and your yield on cost is going to snowball. In 30 years, you're not going to have a 3% dividend yield. You'll have like an 8 or a 9% yield on cost of the portfolio. That's really the power of dividend growth investing. So let's see what you got here in your technology slice. You got VGT, really great ETF. You got Texas Instruments. You got Apple, you got Microsoft, and you got Cisco. Okay, so these are all really, really high quality companies. Another one that you could look at, which is technically considered a technology company, is Visa. Visa is another really, really high quality technology company that would make a good addition to your portfolio. In terms of the allocation, Cisco, yeah, Texas. Me personally, if I had 30 years, I would lower Texas Instruments down to 10. I would move Cisco down to 10 personally, and I would increase Apple and Microsoft and VGT. That's me personally. Once again, 30 years is a lifetime of compounding. You want to focus more, like you're going to reduce your current yield. That's okay. You're going to have a lower current yield. You're going to pay fewer taxes for the next 30 years. But once you reach retirement, that's when you're going to see that snowball just take over. Okay, really, really important. ETFs. What do you got here in ETFs? You got VGG, VTI, VOO, SPHD, and VWO. These are fine. These are fine. You got growth. You got the total stock market. You got S&P 500, SPHT. It's a monthly dividend payer. It's fine. Yeah, these are fine. Like honestly, like this is more conservative than you need to be, if I'm being honest. It's pretty conservative, which is good, right? Like VTI, VOO, they will underperform VUG and VGT because they're more focused on growth and because you have 30 years. But I don't think anyone can go wrong with the total stock market and VOO. But I just want you to know that these are pretty conservative, which is also a good thing in my opinion. Let's see what you got here in real estate. With real estate, you got VNQ, you got Realty Income, DLR, and Stack. Yeah, these are good. Check out two others. Check out PLD, Prologis, and AMT, American Tower. So those are the two that I would check out in addition to this. And in terms of the weighting, I think it's fine. Realty Income, I personally would lower and I would increase DLR, but that's just my personal opinion. Once again, looking at 30 years. Let's see what you got here in your industrials and your automotive. You got 5 holdings in here, 3% dividend yield. This is a good dividend yield. You got 3M, Waste Management, High Five, Lockheed Martin, Genuine Parts, and Ford. Okay, so I think these are fine. I'm trying to think of other really, really growth-oriented industrials. Waste Management is probably the best one in here in terms of growth. Waste Management, 3M is good, Lockheed Martin is good. Genuine Parts and Ford, yeah, I think these are okay. This is more of a personal preference in my opinion. Like I think they're okay. Like this Genuine Parts is a dividend king. They've increased their dividend for over 50 years, like really, really great track record. But you're just not going to see the growth like you are with a Waste Management, right? Like with Waste Management, it's just, no, you can't even compare it. All right, let's take a look and see what you got here in financials. In financials, you got a 3.5 dividend yield. You got ADP, you got Visa. There you go. You got Visa in here. It's fine. You can keep it in financials. It's fine. Aflac, Citigroup, and Wells Fargo. Traditional banks, you got Visa. I think of the group here, I think Visa is the best. Me personally, I would have Visa at the highest allocation. There's two sectors that are really difficult for me to predict and to kind of forecast what's going to happen. That is financials and technology. The technology sector and the financial sector, they're so difficult for me to forecast what's going to happen in the future. There's so many disruptors. And so what I would even consider doing is taking a look at the industry-specific financial sector ETF from Vanguard. It's ticker symbol VFH. It's really good. Like me personally, I really like having that in there. And then that way you don't really have to pick the winners. You don't know if Citigroup is going to be a winner. You don't know if Bank of America, JP Morgan, Wells Fargo, right? So me personally, like, if I were constructing this portfolio, just in my pure opinion, I would have Visa at 50% and I would have VFH at 50%. That's just me personally. Let's take a look at healthcare. Healthcare, you got 10%, you got Johnson & Johnson, AbbVie, and you got CVS. There's a few other really good ones that I would highly recommend you take a look at. If you got 30 years, let me show you something here. I would highly recommend you take a look at Stryker. Stryker is a healthcare company. It's a dividend aristocrat. It's increased its dividend for over 26 years. It has a lower starting yield, but this is the key thing that you want to take a look at. This growth rate, it's grown its dividend on average over 10% every single year. In 30 years, your portfolio is going to be enormous. It's going to, the appreciation and the compounding that you're going to see over 30 years is just remarkable. When you compare that, for example, with CVS, CVS is a good company. I think it's going to do well. But when you compare a company like Stryker with CVS over a 30-year time period, in my opinion, you're going to have a lot more potential with a company like Stryker. Let me give you another example, one that I have in my portfolio that I like as well, as Medtronic as well. Medtronic is another great company. It's growing its dividend. You know, look at the CAGR, the compounded annual growth rate over the last 10 years. It's increased at over 13%. You look at the dividend. Like, this is another really, really high quality company that you can look at, that you can hold in your portfolio. So just a few ideas, a few thoughts. That's just my personal opinion of companies that you could consider looking into for the healthcare space. With healthcare, I would focus on growth, like really just growth. And Johnson & Johnson is a great pick. AbbVie is a great pick. With CVS, I'm on the fence. That's just my personal opinion. I think it's a great company. I think it's going to do well long term, but given the opportunity that you have over the next 30 years, I think you're going to have more opportunity in other organizations. Let's take a look at your consumers. You got Pepsi, Coca-Cola, Kimberly-Clark, Nike, and Gap. Okay, so what I would recommend you do is take a look at Costco and Walmart. I really like Costco. I really like Walmart. Another one that I really, really like, if I had 30 years to invest, like I would be investing into this company right here. McCormick is a great dividend growth company. It's a recession-proof stock, in my opinion. It's a really, really great company. This is another really great one that you could take a look at. You know, in terms of what you have, Nike is a really high growth company, really good for the next 30 years. Kimberly-Clark is really good. Kimberly-Clark has just gotten hammered these last couple of weeks. Really, really great company. You don't see Kimberly-Clark at these levels very, very often. And I don't believe, this is my opinion, I don't believe it's going to stay this low forever. So nobody ultimately knows. I mean, it's possible that it comes back down here. I will continue to buy as it goes down, but it's a great, great company. Pepsi, also really, really good. Coca-Cola, really good. Gap, I'm not a big fan of clothing retailers. That's just my personal opinion. I'm not a big fan of Gap. That's don't mean to offend anybody if somebody is like, yeah, I'm wearing Gap right now. Like, hey, it's just for me as an investor, it's not my preferred avenue, I guess you could say. Let's take a look and see what you got here in utilities. Utilities, you got Linde, you got NextEra Energy, you got PPL, and you got Duke. In my opinion, NextEra Energy should be the highest. In your situation, I would put NextEra Energy, in my opinion, at 50%. This is because of the stock split, the stock split. Really, really high. In my opinion, the best utility for your time horizon is NextEra Energy. These others are good, but NextEra Energy is by far the best in my opinion. Telecom, you got AT&T, you got Qualcomm, you got Disney, and you got Nokia. All right, so personal opinion, Nokia, not a big fan of it, but you know what? It's possible that they have a turnaround. It's something, who knows? AT&T, for the next 30 years, man, like the advantage of M1 Finance, the cool thing is you get to leverage the current yield of AT&T, and that current yield is actually going to compound your other holdings. So that's the big advantage of holding a company like AT&T in a portfolio like this. But in my personal opinion, like Verizon is also really, really good. Like you could, me personally, this is my opinion, I would swap out Nokia with Verizon. That's my opinion. Disney also really good. I don't know, like you could even, I think over the next 30 years, I think Disney is going to outperform AT&T. Disney is not historically really a dividend focused organization, especially as they transition to streaming. I think, but still, I think for the next 30 years, like Disney is going to outperform AT&T in my opinion. All right, let's take a look at your last slice here in energy. Energy, you got Chevron and ExxonMobil. Yeah, I think this is fine. These are really high quality companies. ExxonMobil, man, like I feel bad. Like I don't know what they're going to do. They're having layoffs. They're going to have to cut their dividend most likely. Like there's a lot of stuff going on with energy. Me personally, what I decided to do with my portfolio is I just took out energy. I took out energy altogether, and I have exposure to the energy sector through my ETFs. I don't know, but having it only at 2% is fine. I personally wouldn't do more than 2%. Thank you so much again for sending over your portfolio. What I would really encourage you to do is focus on growth, the dividend growth especially. You have 30 years of compounding. Right now, you don't need a 3% dividend yield. Like you just don't need it. Me personally, I'm looking to retire in the next 8 to 10 years. I need a 3% dividend yield. You don't. In 30 years, you have so much time for your portfolio to compound and increase your yield on cost. If I was in your shoes and I had 30 years of compounding ahead of me, I would strive for a current yield of around 1.5% to 2%. By doing that, you're going to pay less taxes if this is in a taxable account over the next 30 years. And once you reach that 30 years, like the snowball is just going to take over, and you're going to have so much more growth in your portfolio if you were to focus it that way. So really, really encourage you to reevaluate, reassess. For example, like with the telecom, like AT&T. AT&T, if you got 30 years, AT&T is a great current income company. It's not a company that you're banking on to snowball over the next 30 years. Whereas with Disney, you would, for example. So that's the type of stuff that you want to look at. Another great example is with Texas Instruments. Texas Instruments is a great technology company. It's not growing anywhere near as fast as Microsoft and Apple. And that's why I would encourage you to focus more on growth. But growth also has to do with the dividend growth. Something to be aware of. I hope that is helpful. Once again, thank you so much for sending over your portfolio. The best of luck to you and your fiance. Thank you so much, everybody, for watching the video. I know that this video was a little bit longer. If you're new to the channel, I'd invite you to subscribe. If you liked today's video, give me a thumbs up, and I'll catch everybody in the next video.
You know what? I think we're gonna be friends. Can everyone say hi to my friend? That's crazy. I just wanted to say thanks. I'm glad you came along, partner.